Welcome to Africa Business Weekly. I'm your host, Akin Obakeye. Now let's dive into this week's top stories and explore what's shaping the future of business in Africa. South Africa's inflation hits its highest level in 10 months. We'll find out the drivers and ripple effects to the economy. And in West Africa, Champion Breweries moves to acquire all brand assets and intellectual property of the Bullet range of ready-to-drink alcoholic and energy beverages. Now, what does this mean for the consumer goods company listed on the Nigerian exchange? And in East Africa, Rwanda raises its interest rates, citing inflationary pressures. Now, this and more are what we'll be bringing to you on the show today. But let's cross over, first of all, to Johannesburg and get some updates from Karabo.
Thank you, Akin. Well, South Africa's consumer inflation has ticked up to 3.5% in July, its highest level in 10 months. And this was driven by sharp increases in food prices, municipal tariffs, and a rebound in fuel costs. Household food budgets are under pressure, with meat and vegetables leading the surge, while water and electricity hikes have added to the squeeze. Now, to unpack the latest consumer inflation data, CNBC Africa spoke to Koketso Mano, senior economist at FNB.
This jump really just highlights what a lot of analysts have been flagging around administered price inflation. So we saw those utility costs coming through in the month of July, which is traditional, and it was anticipated that they would result in this surge in inflation. So it's not as though the surge was, a surprise, but it does speak to the fact that especially if the Reserve Bank is speaking to lowering the inflation target, that some of these costs will have to adjust over time, in line with the lower inflation objective. Once again, it highlights to us, as has been the history, that utility costs tend to run well above headline inflation, and we saw that again today. So that is the significance of the numbers for July.
Looking at specific drivers, food and non-alcoholic beverages inflation accelerated to 5.7%, its highest this year. Where's the biggest pressure showing up there?
It is with meat inflation. So you would have heard about, the different issues in that sector around foot and mouth disease that is still affecting, the beef industry. So you're seeing a lot of that price pressure coming through in meats, particularly beef. When we speak to our agricultural economists, they seem to think that you could get some sort of demand destruction going into the remainder of the year. So maybe these price pressures will not be fully passed on to the consumer, or not as much as they have been, but you could also see a shift to other proteins which would rebalance the basket. Either way, we are relatively concerned about meat inflation when you look at the entire food basket. Meanwhile, your fresh produce, for example, your oils and fats managed to drive down some of that price pressure that we saw on the monthly or month-on-month numbers for food and non-alcoholic beverages inflation.
So given this sort of mixed picture around food categories, as you've noted, vegetables are up, others, coffee easing, dairy and eggs in deflation, cheese rise. Does this then suggest that food inflation may have peaked, or are pressures still building?
We don't think, food inflation probably has peaked. What we do think is the monthly momentum could slow going forward, right? So that's what we're hoping for. We have started to see this in the past couple of months, where we did see the month-on-month pressure, so the momentum starting to slow. So we hope that that will continue. But on a year-on-year basis, and which is something that you will see across the basket, what will really come through in the second half of this year is the fading of positive base effects, right? So when you look at the year-on-year numbers and you compare to 2024, what has really been supporting us is that last year you had this high level when you look at the index, and then when you compare 2025 levels to last year, you would have seen that supporting lower inflation rates. But as you go into the second half, those positive base effects come out of the system, and as a result of that, you will see a lot of the numbers normalizing again. So unfortunately, that is what's going to keep some of these numbers elevated when you look at them on a year-on-year basis.
Continuing on South Africa's inflation picture, the latest Debt Busters Index shows that many households remain heavily indebted. Personal and payday loans are now a lifeline for millions, with the debt-to-income ratio back at 112% and debt servicing costs at their highest since 2017. Now, for more, CNBC Africa spoke to Benay Sager, executive head of Debt Busters.
Factors beyond our control. I think you mentioned inflation earlier on. A little bit higher than what we would have liked, but we also need to recognize inflation in South Africa is mostly driven by regulated things like electricity and rates and all of that. Generally, those go up in July. The petrol has been up and down, but when we look at the overall picture, we see that consumers are not really living beyond their means. They're just really, really stretched, and it's predominantly due to lack of growth in the income part. So when we look at the incoming cohorts, for example, compared to 2016, the nominal incomes had only gone up by 10%. And during that same period, the actual CPI cumulative effect was over 50%. So there is a real sort of income erosion that has happened. I think, as you mentioned, as a result, we're finding, particularly since pandemic, the higher income earners, especially those taking on 35,000 Rand or more, having to borrow to support a wider range of individuals, to the extent that their debt levels in terms of unsecured debt today is about 80% higher than what it was a few years ago. And I think that's probably the reason why people are feeling a real stretch financially.
Yeah, that's quite a great picture, and also an enhanced understanding that you give us in terms of painting the numbers that our salaries or average salaries have only risen by 10%. Compared to the 50% increase that we have had in the overall inflation basket since 2016. So you can say basically in the last decade, data continues to show that we have gotten poorer, or most South Africans have gotten poorer. So maybe just talk to us a little bit about how people are trying to get by, exactly what kind of loans they are taking out to supplement their lack of income.
Yeah, we track this very regularly. So what we see is that 95% of the people who apply for debt counseling with Debt Busters in Q2 2025, which is the period we're discussing in question, 95% of them came to us with a personal loan already. 54% had what we would call a short-term loan, or what our viewers might know as payday loans. That's generally a sign of significant financial distress, saying we really need to borrow money to make ends meet. I think that's what we're really seeing, play out quite significantly.
Yeah, and you you mentioned the income bracket of around 35,000 per month, just highlighting the pressure. I think that would be regarded as a middle income earner, or a middle class consumer, as is popularly known. But maybe you can just talk to us more broadly about where the pressure points are being felt across the different income groups.
Yeah, and I think it's important to look at it exactly as you say. Traditionally, what we find is the higher earners have a different mix of debt than lower earners. Generally, higher earners will have more of an asset mix, and as a result, the average interest rates for them will be, when you look at it, the impact will be lower. On the other hand, on the lower end, what we're seeing is that almost all of the debt is unsecured debt, and that's been hovering around 23 to 25%. Per annum, and that's really, really high. And as a result, it's eating into a significant portion of the income. So to the extent that what we find is with our lowest earners, they need about almost 80% of their take-home pay every month to service this debt. And after you may be able to do that for 1 or 2 months, but it's really impossible. What we say is, if you are using more than 30% of your take-home pay in terms of debt repayments, you're already in the danger zone. I think that's really what we are seeing in terms of the different income brackets. And you probably see something similar at the top end as well. Those are also needing to use about 80% of their take-home pay to service the debt for a different reason, but almost the same effect that you see up and down the income bands.
And those were just some of the stories shaping Southern Africa for this week. But until next week, it's back to you, Akin.
Thank you so much, Karabo. Now let's join Tabitha in Kigali as she gives us updates from East Africa.
Hello, Akin. Always a pleasure catching up. Rwanda has raised its key lending rate by 25 basis points to 6.75%, citing inflationary pressures. Governor Soraya Hakuziyaremye says the economy remains resilient, with inflation easing and exports performing well.
We decided to slightly increase our central bank rate at 6.75% from 6.5% that we've had since August last year. And there were many considerations before arriving at this decision. One, we start with our core mandate, maintaining price stability, with an inflation target range where we should maintain headline inflation between 2% and 8%. And we've seen that in the last quarter, so from April to June this year, headline inflation was stable at 6.7%. And this is the same headline inflation rate we had in the first quarter. But when looking at more recent months, June and July, actually inflation has increased to 7.3% in July, mainly driven by seasonal effects of agriculture. The biggest production comes in season A, which ends around February. And the harvest, of course, is now not being consumed, but season B as well, which ended in June, had a lower production than anticipated. So that drove up fresh food inflation to 12%. Although we see still moderate core inflation, we made also forecasts based on other pressures we're seeing, especially on core inflation, where our projection for 2025 shows that average inflation for the year will be at 7.1%. And this is above the projection we had 3 months ago, or 6.5%. So as we are approaching that upper bound of 8%, we thought as a central bank we needed to take action. One, to make sure that that pressure on inflation doesn't continue, and we would find ourselves at 8%. But we always know that the central bank rate, which is the tool that the central bank has, is not enough in itself to maintain price stability. There has to be coordination with other stakeholders. First of all, making sure that agricultural production picks up in the next season. And we've outlined also risks to that outlook. We anticipate that the target range will, our headline inflation will be within the range, not only this year, but also next year, with a projection at 5.6%. But to make sure if those risks materialize, we are not going over 8%. We decided that slight increase, but also, as usual, for the next 3 months. After the 3 months, we will revisit our data. We will have more data regarding season A of agriculture and might take decision accordingly.
Kenya's economy is at a crossroads. Moderate inflation at 3.82% and 5% GDP growth, but high interest rates, rising NPLs, and looming Eurobond repayments. We spoke to Raphael Aging to unpack the risks and opportunities.
From a balance of risks, the decision last week by the MPC to cut the CBR to 9.5 was correct in many respects. As you point out, growth is sub-5, to be precise, 4.9. There is necessity to drive that faster if you look at all the balance of risk concerned. There isn't really overcompensation. I guess if you look at the two limbs of policy, there is both action on the fiscal side, but primarily because we are addressing monetary policy concerns, you'd argue that the MPC was correct in trying to jumpstart growth. If you read their communique post the decision, they're pretty clear there is scope for further reduction of the policy rate, particularly if you take the view that the inflation expectations are well anchored throughout to the end of December 2025. So yes, I think they're using one limb of policy to jumpstart growth, which, as you point out in your remarks, is very necessary to be able to get the country to where it needs to be on a balance of risks.
And on the banking sector risks here, Raphael, we are seeing that NPLs are stuck at 17.6% despite the private sector, despite credit growth that we are seeing at the moment. And we're also seeing that this is the highest you've had since April 2015. So from your standpoint, should maybe CBK enforce sector-specific loan restructuring or let banks do the self-correction?
I think they have actually been very clear on addressing the NPL question and actual cost of credit. So if you listen to the governor very clearly last week, they are coming up with a new credit pricing framework, The central bank has proposed in 2 discussions papers now a framework for using benchmark rates transparent to everyone in the hope that administratively, with this sort of transparency, they can begin tankering down lending rates. So yes, the restructuring of loan portfolios are similar to what was used in the COVID period is not in play. What is, however, in play, which we support and I think will go a long way in addressing the cost of credit question, is a new pricing framework. So banks will be issuing specific models to address a common reference rate that is tied to the monetary policy framework more directly and intimately. So should they move as they did last week, that will immediately transmit into lending rates. So in the next coming days, I think the central bank will be coming to the market with this framework. And I think it's all very positive development administratively.
And in terms of the debt refinancing window for the country, we are seeing global central banks cutting rates. So is Kenya missing maybe a golden chance to refinance Eurobonds early before 2027 maturities, or would these likely spook markets?
They have been very clear that should there be strategic window to access the international debt markets, they will come to the window. If you recall, their liability management operations was very successful last year when they managed to take out the risk around the Eurobond 2024. The strategy that we see both from the National Treasury and of course with their agents at the central bank is that they've used liability management operations very tactically. And if in fact we see policy rates dropping globally, external financing conditions ease, and that's the expectation from the Fed. We expect up to about 75 basis points drop on the Fed funds rate to end year. We will see international capital markets open very widely for the country, and I think the country will be well advised. And indeed, they've mentioned this, that they will consider going to market to finance some of the fiscal commitments they have.
From Kigali to Nairobi, central banks are balancing inflation and growth. The months ahead will reveal East Africa's resilience. That's it from the region. Back to you again.
Very insightful conversations there. Many thanks there, Tabitha. Now, in West Africa, now, Champion Breweries has agreed to acquire all brand assets and intellectual property of the Bullet range of ready-to-drink alcoholic and energy beverages from Sunmark International. Now, David Butler, CEO of Enjoy Core, earlier, the parent company of Champion Breweries, earlier joined us to discuss the development and plans for expansion. Take a listen.
Look, we're super excited about Bullet. It adds a whole new range of product categories to our already existing portfolio. And we love the brands, right? When we started talking about these brands, we said, you know, this is a perfect add-on to where we want to be. So we love the brands.
And now let's look at basically how this plan is. We're looking at something that has to do with asset carve-out. You're looking at taking full ownership, right, in terms of majority stakes now. But walk us through what's the regulation in terms of approval time you're expecting for this takeover.
Yeah, we'll imagine that the full approval process will probably take another 3 months. Before the end of the year, we're certainly hopeful that takes place, and everything seems on track so far.
Well, before we had the lights and camera on us, we're talking about some of your numbers here. We've seen so far, we've seen Champion Breweries been able to double its revenue gross profit in the first half of this year. What does the full picture look like when we're going forward now? And in terms of the plan to consolidate even further, looking at this financial performance and then the reporting lines leveraging on benefits around FX, earnings, the distribution, supply chain, what does the full picture look like?
Yeah, look, I think that this year has been a lot stronger vis-a-vis a very weak first half of last year for many other companies, right? And I think everybody's seen the upside of that this year. I've always said that the stability that we know about the exchange rate and we know about where costs are going is a lot better than sort of taking a guess at everything. We're exceptionally bullish about the Nigerian economy right now. I said the stability has been something that we're really excited about, and it allows you to plan properly. You know, taking stabs at things versus making calculated decisions are two very different things.
All right, now let's look at how you've reflected on the Nigerian market. Now let's look at your presence right now in other African countries, Cameroon, Cote d'Ivoire, Ghana, and the likes. Now, in terms of this acquisition, are you looking to double down in other countries? What's your plan? What's your strategy?
Yeah, I think the strategy for us is really to make sure that we get the existing markets with a much deeper penetration, and we allow for new product innovation, and we allow for the existing products to really embed themselves over here. We believe that although the brands have done well, we believe we're only just scratching the surface. I think as we roll out across other African countries and other countries across the globe, we believe that we've got to do that structured. We've got to make sure that we plan it, and we've got to make sure that it's done in a way that allows us to give the right attention to the new markets that they require.
So at this moment, we're maintaining pace with the 14 African countries where you have coverage.
Sorry?
We're maintaining presence in the 14 African countries where you have. That's where the concentration is going to be, so that you don't spread your resources way too thinly.
Maintain and deepen.
Yeah.
Right? I mean, we didn't buy a business to maintain it. We bought a business to grow it.
Yeah.
So we want to get those roots deeper and stronger, and we want to embed those brands in those countries. And as we do that, then start looking at the opportunities of international companies and countries across the world.
All right, now let's look at your growth prospect and then also your expansion. We're looking to see you raise 5 billion ordinary shares from local and international markets, and also plans to raise up to 45 billion naira from local and international markets. Tell us your yardstick for that and how this would help you in terms of putting that firm structure on the ground.
Yeah, look, there's a few pieces to our fundraising process. You know, part of our fundraising process is to go towards fixing the Champion Breweries facility. You know, we always say if the engine's not right, you're not going to be able to get it to perform at maximum capability. So we're raising money to get our throughput through our factory sorted, and to make sure that we become more competitive in terms of our efficiencies. The other piece obviously talks to the bullet acquisition and capex required to do all of these expansions.
And in other developments now, CSquared, a Pan-African technology company, is expanding its West Africa fibre network with the addition of a cross-border solution from Abidjan to Monrovia. Now, this adds to existing infrastructure solutions from Accra to Lagos. The CEO of CSquared, Ian Patterson, says this backbone represents more than just fibre. It's about building a stronger digital foundation for West Africa's future. Now, he joined us earlier now to discuss more on the journey to realizing a future where no country or community is left out of today's digital revolution. Take a listen.
So this is part of a much broader campaign that we're working on, and we've been working on for some time now, around bringing alternative infrastructure through the terrestrial routes that have previously only been served by submarine systems, to provide more resilience to Africa and to drive the regional connectivity for West Africa in particular. I think everybody probably remembers it's about 18 months ago there was a major crisis where 2 subsea systems went down and put some parts of the continent into blackout for an extended period. And we're working together with our partners, being other private sector operators and governments, to try and avoid that from happening again and drive a new wave of digital inclusion.
Yeah, because it's quite an interesting work that you're doing, and I'd like you to speak to why cross-border infrastructure like this are very crucial, especially for landlocked countries.
Well, look, I think digital infrastructure is the lifeblood of a modern economy in many ways. You know, from the most basic, simple financial transactions through to complex manufacturing processes, everything relies on digital infrastructure and connectivity. If that goes down, the entire economy takes a major, I think, hit. We need to ensure that there is resilience, that the latency is lower, that the cost and the access prices are affordable. Our open access business model helps enable that. We can avoid the need for people to build duplicative infrastructure to try and lower the overall cost of ownership and allow the end users to get the best possible quality of service. So it's really essential. The internet doesn't stop at borders. Business doesn't stop at borders. Crossing over from one country to another in a seamless manner is absolutely essential for a vibrant region.
Let's get to the issue around competition and collaboration. And I'd like to know how, in your model, you are ensuring that other partners see what you're doing, your intervention here, as more collaborative rather than competitive.
Well, look, ultimately, our industry is interesting because we both compete with our customers as well as serve them. And it's up to all of us to find a model that works to reduce the overall cost of deployment and the cost of services to the end users. So with our solutions at the moment, we're working with customers, suppliers, governments, partners, other telcos, both in our existing footprint and beyond, to try and get into parts of the region that have been harder to reach. It requires all of those stakeholders, particularly support from governments, regulators, and other operators to enable that to happen. We've got to find a way to break down any barriers that exist in a collaborative manner. I'd like to call out some of our partners in particular. With our roots that we're focusing on in West Africa, there is not only ourselves, but our government partners in places like Togo and Ghana and Cote d'Ivoire, Benin, etc. Our private sector partners like Phase 3, and then our customers ultimately that we're trying to serve in the most comprehensive manner. It requires that whole ecosystem to come together, and we're very proud to be at the center of making that happen.
Because I remember quite vividly a couple of years ago we spoke to a representative from CSquared about when the Equiano cable came on board, when you were the landing partners to that cable. And I'm trying to imagine, how does this super highway here integrate with Equiano and other subsea cables?
Yeah, so we're the landing partner for Equiano in Togo in partnership with the government there through our joint venture. It's been very successful. We're delivering a terabyte of traffic into a region that previously was underserved with only really at the time one available subsea system. So not only was it limited capacity, but there was a greater risk of a system failure. I think the example of March last year showed how important Equiano was in terms of providing emergency connectivity services to the region more broadly. We've extended those relationships that we built on the back of that crisis and are continuing to serve our customers more broadly. But ultimately, what we're looking to do is integrate not only Equiano, but the other cable systems, both existing and to be launched, into our terrestrial footprint, which will allow, in the event of any sort of issue in any one of the landing stations or the data centers that we're all connecting into, we can roll over and we can serve customers through these alternative access points. So it's very important both for availability, for cost, but also for redundancy to ensure that we keep the level of service to that our customers expect.
And this is where we draw the curtains on this episode. Thank you for joining us on Africa Business Weekly. You can catch all these stories and more on our website, and that's on CNBCAfrica.com. Until next time, stay informed and stay ahead. I'm Akin Obake.